All right, I apologize, everybody. Looks like we have almost full attendance, so we'll go ahead and get today's presentation started. I just wanted to take the time to thank you all for attending today's webinar, Chevron Transformation and the Impact on Retirement Readiness. Before we get started, I just wanted to make note that since we are using Zoom, we may be experiencing some technical issues, but do not worry, we are recording this call and we'll make it readily available on our website in the next day or two. Also, to those of you who have pre-submitted questions ahead of time, we're going to do our best, time permitting, to be able to address all of those at the end of the presentation. But if there any other questions arise during the course of the material, feel free to enter those into the chat, and we will do our best to address those as well. I am the moderator today. My name is Michael Agarastos. I'm a financial planner here at Insight Wealth Strategies, accompanied by Brian Stormont from our San Ramon office, and also Chad Seegers, a financial planner out in Houston. So with all that said, I'm going to turn it over to Brian to start with expression of interest and what we know.
Yeah, great. Thanks, Mike. I appreciate it. So first and foremost, thank you everybody for attending today and taking some time out of your day. We hope that this is a informative session for you, and hope all of you are staying safe and healthy and so forth. And also, I'll echo Michael's point about glitches. If anyone has used the Zoom platform in the last couple months, I know I've used it a ton. Occasionally we run into the minor issues, so we appreciate any patience. So today we're going to obviously talk about the expression of interest process, and I'm going to just say right up front, first of all, we're not HR. Our job is not to try to replace HR, or we certainly don't want to try to pretend that we know more than HR. But our job is to certainly work with our existing clients to digest the information coming out of the company, think about their personal financial situation and how this could be applicable to them, and then think through different scenarios. So today we're going to talk a little bit about EOI, the timeline around EOI, some of the impact on the different benefits. We'll then shift gears and talk a little bit about what we do here at Insight and share with you a couple different scenarios, hopefully provide a couple of different ideas for you. And then we'll conclude with a little bit of Q&A, which Mike has alluded to. If we've got the time permitting, we'll try to cover all the questions that might come in. So first and foremost, so expression of interest. So what are we talking about here? So obviously this is a ROM. This is something that happens in the company every so often. We had Project Alpha, Project Delta a couple of years ago. So to our understanding, the company is looking to try to reduce employee cost by 10 to 15%. So you'll notice I didn't say employee headcount. So the reality is that a very senior employee leaving the company could mean that 2 or 3 maybe lower paid employees would be able to stay. So it's simply a cost reduction that they're targeting on this. And so the way they're going about this is through what's called expression of interest. So that is the opportunity for the employee to subtly, let's say, put forward or raise their hand to say, hey, if the company's looking to reduce headcount, I would be interested in exploring that option. And as we all know, and we'll talk about today, that does not mean that you'll necessarily get a severance package, you'll be let go, but it allows you, this mechanism allows you to express the interest. So what we know about the severance package thus far, so right now we're looking at 3 weeks of pay for every year of service. And one of the things that I hopefully briefly hit on is the fact that this is a very fluid situation. There's lots of changes that are coming out of the company. And certainly the information that we may share with you today may be different next week. And literally, as an example of that, is the 3 weeks of pay for every year of service. So that was actually, as of just a couple of days ago, that got changed. Previously, in other ROMs, we've looked at 2 weeks of pay for every year of service. So that meant that someone with 26 years of service would be entitled to a full year of pay. Now, with the 3 weeks, that drops it down to employees that have 17 years and change of service. So it's expanding the pool. The cap on this whole payout is still 52 weeks. So we're still talking about a 1-year severance. The minimum, though, was increased from 8 weeks to 12 weeks. So that's the new minimum. So again, Lots of fluidity to the situation, and I'm guessing that we'll probably find more fluidity as things move forward. But with regards to the expression of interest process, there's a couple different scenarios that are occurring. And so right now we are in the midst of an accelerated expression of interest, and then there'll be another EOI that starts to kick in later this year in the summertime. In fact, one of the things that we were going to share with you today, and we have it right now, is the timeline on the accelerated expression of interest, because a lot of people actually were either not aware or loosely aware that that was actually occurring. So the current accelerated EOI began on April 21st and was completed on May 8th. So that was the time period where employees were able to essentially raise their hand and say they were interested in being left standing. So severance packages will be provided to those employees who go through the process and are left standing. So the timeline on all that was May 11th to the 22nd. Those accelerated EOIs were going to be reviewed. May 26th to the 28th. So literally, as we're speaking right now, the employees that are going to be impacted by that will be notified, and then they'll go through a redeployment period. So some of those employees who've expressed interest may not necessarily get left standing. They may have to apply for another job, or there may be another job that's found for them. And so they end up in perhaps their same department or perhaps even a different department. It's, again, very fluid. But those folks who are on the accelerated EOI schedule will have a final day on July 10th. Now, one of the reasons why we shared this timeline was because as we were formulating this entire presentation, we didn't know what the second round of EOI was necessarily going to look like in terms of timeline. And so that obviously just got released the other day. So now we know more about what that timeline is going to look like. And you can see here, there are multiple rounds. And so the rounds essentially start, the PSG is 28 through 30, so pretty high up. And then they start to move down in round 3, and then round 4, we're looking at PSGs, 24, 25, and below. Now, what's kind of interesting about all that is that certainly with the round 4 EOI, you can see that the jobs available review week is September 21st, job application period is the 28th, selection process is the 12th. Then notification occurs on the 19th. We had a lot of clients who went out with Project Alpha a number of years ago. This is a very similar timeline to those individuals. And why that's important is that many of those Project Alpha employees who were left standing were able to push their severance payment into the following calendar year. And so obviously for tax planning purposes, for many individuals, that would be advantageous. Not for everybody. There's certain circumstances where that may actually not be desirable. But for most individuals, it is. And as we'll talk about in a little bit with some of the timeline around all of this, that October notification week means that probably looking at a final day of employment, maybe perhaps in November. And so now all of a sudden that 60-day window becomes really critical. Now, EOI is the expression of interest process. We have heard from some clients who've mentioned that there may be an additional call to action called transformation. So basically, EOI is the process by which the company is looking to reduce the employee cost by 10 to 15%. If they don't hit those targets, either company-wide or in specific business units, there may be an additional round that happens in the third or fourth quarter, depending on the results of the EOI process. So again, very fluid situation, and whether this applies to somebody or not, if they're going to be left standing or not, if they even want to raise their hands, each case is individual. And we're certainly working with existing clients right now to really think through, is this the right thing for them to do or not? Now, in the process of separating from service, there's going to be some choices that need to be made. And I'll turn that over to my partner, Chad, and he can kind of walk us through that.
Biggest question we're getting is, how does this relate to taxes? If you're in a position where you do receive an offer and you decline that, our understanding is you're not going to have the ability to receive a severance. Also, Texas and California, if you're not retiring and you do have the ability to get a severance package, you're going to be able to collect unemployment. If you're in a different state, this is sort of a state-by-state deal. So I checked there. The other question we've gotten over the years is, will the severance be the same if you raise your hand or you're left standing? Yeah, they're going to be the same package. There's nothing different for one versus the other. The last piece is, how is the severance payment actually classified? And so while it's a separate sort of post-severance payment package, this is ordinary income tax. Taxes will be withheld from it. There's a big key caveat, and you can't direct any of this payment to any of the Chevron retiree benefits, 401k, Chevron Retirement Plan, pension, etc. And so there's actually not a lot of flexibility with respect to the severance payment itself. Now, when we think about the timing of when this thing all takes place, you've got your termination notification, and due to something called the WARN Act, which is applied if there's mass layoffs greater than 100 employees across the country, employers have to allow for 60 days for sort of a hold harmless thing to take place. And so what took place during Alpha was a packet was sent to an individual, and they had 60 days to return that packet, signed and executed to Chevron saying, okay, we're not going to sue and we're okay with everything that's been offered. And so the game that was played then was they held on to that packet until the week before everything expired. They sent that packet back to Chevron. It took Chevron typically a week or so to process it, and that pushed some people into the first and second payroll of January with respect to their severance. And so that's pretty attractive, actually. The unfortunate thing is, given the timeline that's been shared with us with Chevron folks and what Brian went over, is that flexibility is not going to apply for a lot of people from a tax benefit perspective. So now that this is what's referred to as a triggering event, there is some other tax plays that you have to consider. One that's thrown around a lot, if you've been to any retirement readiness seminars, is net unrealized appreciation. This is in the tax code, and it essentially goes along with money removed from a retirement plan. So most people at Chevron have been saving, putting money in the 401k, and Chevron's been matching until about 2014 with ESOP Chevron stock. And so the tax law, in simple terms, if you remove $100,000 of value from a retirement plan, you pay tax as if you pulled $100,000 of value out, just like a paycheck. That's true with the exception of company stock. And so those Chevron ESOP shares have a cost to them. And that cost is, for most people, it's around $17.70 a share. What net unrealized appreciation says is you can remove that same $100,000 of value out of the Chevron 401k, and you pay ordinary income tax on those Chevron ESOP shares as if you only removed $17,700. The remaining gap between the $17,000 and $100,000 is what's referred to as the net unrealized appreciation. If you follow all of the non-retirement account rules, that's taxed at long-term capital gains tax rates and the dividend tax rates. Now, the key is, this is not a straightforward transaction. One of the biggest mistakes we see is advice is given to roll money over into a retirement plan after you retire, and that's actually false. You can leave money inside the Chevron 401k plan as long as you want. The moment you remove a dime from the plan, net unrealized appreciation transaction itself has to take place by December of that year. And that transaction in itself, what you're looking at on the left-hand side, this is a flow chart which we produce for every client. It's not so straightforward. You typically have to put the money into 3 separate buckets. We tend to run this analysis for each individual client. We go over what the tax benefit is in their personal situation, produce the flow chart, and we also typically handle this with the client in Fidelity on the phone. Fidelity, depending on who you talk to there, you'll get an experienced person or a not experienced person. And this transaction can take place, and it can be seamless as long as you follow the correct steps. Let's go next. So the question we're having come up is healthcare considerations. This has been a change really in the past 6 years, I would say. Typically, COBRA leaving any employment was very punitive. It was extremely expensive. And so it made sense for most people, if you have greater than 75 points, to consider getting on the Chevron retiree pool. Now it's actually more beneficial, since you're having a qualifying separation of service. It's more beneficial from a cost perspective to get onto Cobra for 12 months, which is what Chevron will now cover. And you're only paying a 2% administrative charge over and above what your monthly rate is. And that's been extended from the previous 6-month pool. Now, our understanding, and you have the ability after that timeline is up to then go back to the Chevron retiree medical. What we've done is go through and line item healthcare costs with each client in their plan, which we found helpful. And so whether you're close to 65 at Medicare age, it's going to be a slightly different decision. Several years out, it would be an absolute, you want to take the Cobra coverage and then switch to the retiree pool a little bit later down the road. This has been a big change in the planning world, and a question that we get that comes up all the time. So another decision you're going to have to make. You've got the savings that you've worked hard to accumulate inside the ESIP, and then you've got the Chevron Retirement Plan, which is the pension and/or lump sum. And that's a pretty big decision. And there's some factors that go into that. A big one that a lot of people have heard of, and that's what's called segment rates. It closely tracks corporate and treasury bond rates. Rising interest rates mean a fall in that lump sum. This is a decision that you have to make with a specific set of documents that we help prepare and walk through with every Chevron client in executing this stuff. And the IRS has segment rates that publish around the 15th of every month. That's all good and well. Chevron, having a process for everything, has their own process for the effective segment rate, which ideally smooths the line for those people that are retiring from any one month bump in rates. Because what they do is throw out 2 months and then use a rolling 3-month average. And so there's two decisions. One is what's going on with interest rates now, and then 6 months when this is all over with. The other is this money is actually wired from the Chevron pension plan directly into your individual retirement account. And then you have to redeploy that capital. And what we all know is an uncertain economic environment, uncertain market environment. The money's essentially in the money market. You've got to make the decision on where to put it next. So I'll let Brian also speak a little bit to segment rates right now.
Needless to say, we've been getting a lot of interest from people about where the segment rates are going and what interest rates are going to do. And certainly, I have no crystal ball. That's not something I have currently. It broke a long time ago. But one of the things I can kind of take a look at is the trend lines and how we see them coming around. So, for example, on the right side of this chart, you've got the Chevron pension segment rates, and you can see that last 3 sets of dots. So the low red one is segment rate 1, the blue is segment rate 2, and the yellow is segment rate 3. That's for the July 1 annuity date. So for the July 1 annuity date, what Chevron does is they take February, March, and April's IRS segment rates. So that's the chart on the left. Those 3 months, the average of those are what Chevron uses to calculate their July 1 annuity date. Now, as Chad alluded to, with the pension lump sum, and again, whether you take the lump sum or the annuity, that's a whole decision process that we can go through with individuals. But to the degree that you choose to take the lump sum, the segment rates are very important. And all else being equal, the lower the segment rates are, the larger the lump sum is. The higher the segment rates are, the less the lump sum is. So segment rates going up can be costly if you're not careful. So if we look at the July 1 annuity date, it's got the months of February, March, and April in there, as I mentioned. Now, if I look at the month of March, you notice there's a significant spike there. That's a reflection of some of the real turmoil that was going on in the bond market back in March when we were in the midst of the real big sell-off. And there was quite a bit of a dislocation in the corporate bond and even U.S. Treasury marketplace. The good news is that settled down, and so we saw rates come back down in April. And again, as Chad alluded to, what happens is every month the IRS issues rates for the previous month. So we know in May what the April segment rates are. We're now obviously in the month of May, so we won't know until July what the segment rates are. But if we look at the corporate bond marketplace right now, yields are a bit lower today than they were in the month of April. So if nothing else, we expect that the segment rates for May should stay at the same level or maybe even decline some. Now, again, if I have those 3 months, February, March, and April in there, ideally, I'd like to not have March be on my calculation. So that means I need to move forward in time. So if I look at the August 1st annuity date, so now we moved it 1 month forward from July 1 to August 1, I now have the months of March, April, and May in my calculation. So March is still in there. When I go to September 1, now I have April, May, and June. So now March has fallen off. And that, depending on where interest rates go in the next couple of months, could have a pretty nice impact on my lump sum amount. And then as we look into October, we're looking at May, June, July. And then for a November 1, we're looking at June, July, and August. So now we're starting to talk about months that are ahead of us, and we don't know what interest rates are going to do. As Chad alluded to, if the economy really begins to stabilize and things really begin to turn around, we could see interest rates start to rise in that environment as a reflection of optimism and concerns around inflation. So that's the long way around the barn to say that right now the trend lines appear to be positive for people who want to take the lump sum, but we are watching this very closely. And certainly, as has been mentioned already a couple times, we issue this chart and our thoughts on the segment rates once every month when the rates are issued by the IRS. And so if that's something you're interested in, I would absolutely encourage you to sign up for it.
So thinking through this, there's a couple of key things to consider. If you're likely going to raise your hand, and you've answered that question, do I know if I can retire or not? You want to make sure that you're maxing out any pre-tax dollars between now and the end of the year. You're going to have a pretty big tax bill when the severance hits. When we're talking about this stuff with clients, we've done the work sometimes a couple of years in advance. We unfortunately had some scenarios, especially with Alpha, where people had to make decisions in 48 hours. And you guys have a very long working career. Fortunately, we understand the toolbox that's there. But the typical questions we're having to answer is, do I need to look for some part-time or contract work after I retire? Or can I fully retire? Can I do a career change? We've had people that did career changes successfully, and we were solving for sort of a minimum income requirement. How close are we to 90 points? That's on your total pay and benefits statement. What we found is, post 75 points, this tends to get in the noise, especially when you consider the severance that's on the table and what goes on with COBRA. It's largely dependent on where you are age-wise and what you have to carry for that cost pre-65. That's why we've taken to line item healthcare costs when we're looking at these plans. The pros and cons, CRP, lump sum versus annuity. So something to think about there that Brian touched on. The majority of people take the lump sum from Chevron's retirement plan. I think Chevron's number used to be around 90+%. And really, it's not saying that they don't want the annuity. It's sort of asking the question, how much of my income in retirement do I want guaranteed? Do people want to leave money to a beneficiary after they pass away or their spouse passes away as well? That's kind of dependent on person to person. You can go out in the private marketplace and do that on your own, in some cases better than what the Chevron offering is. And that money's free and clear. You have ultimate liquidity and control over that. Do I know what my retirement restoration plan payout is? That's a PSU 26 and up. You've got another bucket of taxable money there, and you get to determine when that stuff is paid out with a little bit of flexibility. So typically you want to sort of back in and map out when those payments are going to hit and look at some cash flow and tax models. Is this the right choice for you? We've had people over the years that were about 2 to 3 years out from being able to retire. You get into your really high compounding years, your liabilities get wiped away right towards the end. And for some people, it's just not the right choice. Sure, the severance may be attractive. You just may not be able to do it. And unfortunately, that's what the value some of this work provides. It's not the right thing to do for everyone out there. If you're left standing, obviously there's no choice. What are the potential tax implications if you are left standing? There's only a couple things you can do with that based on the timeline that we understand right now. And that's going to be if you're left in that last group. And then for PSU 26s and up, what do we do about LTIPs? What do we do about that DCP? That's another taxable income bucket. And how do we map that out with things like Social Security, things like if we are going to spend down our severance for the first year, year and a half in some cases of retirement, what's that going to look like? And so now Brian will walk you through sort of a case study on how we do these things.
Sorry, I'll unmute myself. I'm a veritable rookie at this. Here at Insight, we do a variety of different planning work for clients. Not every single scenario or every case you're seeing here applies to each individual, but it gives you a good sense of sort of what we do. And so risk management, wealth management, tax planning, estate planning, all those are very critical items in a comprehensive financial assessment. But the vast majority of our clients who initially start working with us or approach us, it's the retirement planning that's the most important part for them. That's priority number one. Can they afford to do it? What does it look like? And so there, we go through a variety of different areas to help them understand their situation in terms of cash flow planning, lump sum versus pension, employee benefit maximization, Social Security timing. But one of the things that we did today was we wanted to just kind of give you a sense of some of the decisions around EOI and the impact that it could have. So I'm going to go ahead and share with you a few scenarios real quickly. There we go. So this is some tools that we use here to do some of our retirement modeling. And so this is Joe and Jane Chevron. You may know them. Joe and Jane obviously are not real individuals. These are just fictitious folks that actually are based off real clients, but we've changed the name to protect the innocent, as it were. So Joe and Jane, we went ahead and we created a financial plan for them. And in doing so, with this software, it's very, very technical and thorough. So we're going to go ahead and we're going to include every piece of real estate they may have, whether it's their primary residence or rental properties, vacation properties, all their various investments, their cash, their qualified retirement plans. That's going to include the ESIP and the lump sum. We're going to have the stock options and deferred comp if that's applicable. Also, income sources. So that's, again, where we can look at, you know, their salary, Social Security, any other sources of income like a pension, expenses. We're going to go through that in a very thorough manner. We're going to include all the medical expenses and so forth as that transitions through retirement. So we do not leave any stone unturned here. We do not do just sort of back of the envelope calculations. We want to know with a high degree of certainty, how does this look? Once we have all that data in the system, we're able to create lots of fun different reports. We can look at estate planning, tax planning, investments, insurance, lots of different areas that we can give feedback on. But the cash flow report is probably the most important case. And so this is Joe and Jane right now. And this was Joe. He was planning on working through this year between his salary and his SIP. He was going to have about $338,000. He was going to retire at some point in the latter half of the year. That would qualify him for a prorated portion of the SIP for next year. And one of the things that we said unequivocally was his retirement looked great. Joe, you and Jane, ready to retire. Let's talk about what you want to do and where you want to travel and, you know, family you want to visit. So his ability to retire was already certain. And that echoes Chad's point of, is this the right thing for me to do or not? So the first thing is you got to determine it's the right thing. Once we know that that's the case, then we can say to Joe and Jane, hey, there's this EOI out there. Let's talk about the impact of that and whether or not it makes sense to be left standing. So one of the things we want to look at is if you got the severance in 2020 or in 2021. Now, in 2021, that would be pretty ideal. So here, this is his income as modeled out on a year-by-year basis. So he's getting the salary and the SIP this year. He then gets his severance paid out in January. And again, he qualifies for prorated SIP. Whether or not, we don't know obviously what this number is going to be based on you know, conditions inside the company this year, but this is kind of what we'd estimated earlier in the year. So this is a scenario that would be really ideal because you've got a pretty significant amount of income spread over 2 years. Unfortunately, as we saw in some of those rounds, round 2, accelerated EOI, that just simply may not be an option to be able to spread it over 2 years. So in this case, Joe and Jane are getting that salary and the SIP to happen in this year. We're talking about $600,000 of gross income for them. So not the most ideal set of circumstances. And in fact, we can actually tell them, because the software does comprehensive tax planning, we can tell them what their tax situation looks like if they can spread it over 2021 and 2020, or if they have to take it all this year. And you can add the numbers here in the federal tax bracket, but we're looking at about, $110,000 of federal taxes over 2 years versus about 150. So nearly about a $40,000 difference in taxes. So obviously, to the degree that a person can push it into next year, that would clearly be advantageous. It just may not be in their control. But this is some of the software that we can use and bring to the table to help clients evaluate, hey, does it A, make sense for me to even be able to raise my hand? And then B, if it does, what are the implications of that? What if I have that tax hit this year? We also then want to adjust for the healthcare costs, as Chad alluded to, with the 12 months of COBRA at the very reduced rate, and then you transition over to the retiree medical. One spouse may switch on to Medicare at some point while the other one retains the old retiree medical. All those factors need to be considered in the cash flow. I will say to everyone who's listening today, if you are thinking about EOI, one of the things that you might want to consider doing is taking a look at your 401k contributions and making sure that that corresponds to when you may be separating from service for the year. The reason why I bring that up is I know that there are a number of employees who look to basically level their contribution across the entire year. And obviously, if you're separating from service earlier in the year, you're not going to get your full contribution in. And so that could be upwards of $26,000 of deductible taxable income this year. And to the degree that you then have a severance check also land this year, you're going to want to have every single penny of deductibility that you can. So I would encourage everybody who's listening to today to go and take a look at their paycheck. We can help you do this too. We can sit down with you and review this, but make sure that you're not going to lose out on deductible contributions if you are looking to raise your hand and be left standing. Mike, I'll turn this back over to you at this point. And so, again, here at Insight, we have offices spread around here in the Bay Area. We have our primary office here in San Ramon and Bishop Ranch. We have an office out in Point Richmond near the Chevron Refinery. We also have offices down in Houston, which is where Chad and the rest of that team resides. We have multiple financial planners here to be able to help you with financial planning, financial wellness, investments, retirement planning, rollovers, tax reduction strategies, long-term care and life insurance analysis. That is basically what we do, and we've been doing it for a long time. So, certainly if you have any questions about our services or you have questions about anything we talked about today, we would very much love to be able to speak with you. That being said, people were kind enough to actually submit questions in advance, and it looks like we even had some questions come in during the presentation. So I will transition over to this sort of Q&A session for everybody if you like. Sorry, Mike, you're still on mute, buddy.
Sorry, everybody. All right. So, Brian, first question I'll direct towards you. So question was, is it better to take the lump sum on the pension plan or get monthly payments?
That's a really hard question. And there's a lot of factors that play into that decision. We certainly go through a decision tree process with clients. So some of the considerations that need to be taken in are things around longevity. So obviously, if you have a lot of longevity, that could make the annuity more attractive. I mean, obviously, if you're not in good health, taking the annuity payment, probably not the best idea. Conversely, if you take the lump sum, you got to invest it. And the question is, well, what's the rate of return I need to achieve to be able to equal the annuity payment, assuming I live to a certain life expectancy? So again, with every individual, that's a unique decision process that we would go through. But again, things like estate planning. So do I want to leave money to beneficiaries? Is that important or not? That might be an important consideration. Inflation, because that is a fixed payment. It does not go up over time. So if inflation were to set in, do I have other assets that will hopefully keep up with inflation to offset that or mitigate that risk? So there's a whole host of different considerations that one would want to take into account. And that's certainly a conversation we have with lots of folks.
Awesome. Thank you, Brian. So, Chad, this next one I'm going to direct towards you. What are the expectations for the IRS segment rates over the coming months?
Near-term bond market looks pretty flat. You got the Fed that's committed to keep interest rates low for an extended period of time, which does have an effect on what goes on with segment rates. The other component of that, though, is what goes on in the corporate bond market. And so if the economy starts to move more and more in a positive territory, the natural direction of rates tends to be up. If there is an inflation expectation, it doesn't necessarily have to mean there's a real expectation in the system, but just expectation of inflation coming back rampant, you could also see rates trend up. What we see in the market right now, sort of out to July plus, you don't really have that much of a concern. Where we're looking at rates creeping up is really the second half of this year.
Perfect. So this one I'm going to direct towards both of you. Feedback Insight has received on expected severance packages for upcoming events in 2020. That was the bulk of, today's webinar, but any personal client stories you could share with the gentleman who asked the question?
I mean, for myself, the overwhelming response for people who are thinking about it is, hey, great, I was pretty close to retiring anyways. I mean, at the end of the day, the reality of the situation is 1 year of severance. If that's going to make or break your ability to retire, I question how capable you are of being able to retire at this point. That would generally kind of make me a little nervous. Most of the folks that we've gone through the numbers with and said, hey, this looks great, you should consider taking the package, it's because realistically their numbers already were pretty strong around retirement planning and the probability testing and the stress testing that we do with clients. So they were already looking pretty good. And so the severance is just really, it's a nice way to exit out of the company, and they were already close to retiring. So I think, I can't stress enough to Chad's point when he was talking about some of the questions to consider. The biggest one is, am I capable of being able to retire right now or not? So that's been a big issue that we've been talking about with folks.
Okay. So I'm going to skip on over to a live question because I think it was mentioned multiple times. Question is, unemployment benefit for California. Did I hear correctly? If you do get a severance, you may be able to also claim unemployment. So I'm going to go back to that slide as well. And I think, Chad, you touched on this a little bit. Chad?
Yes. So yeah, this is a state-by-state rule. Our understanding is that right now Chevron's not going to contest any unemployment benefits or any eligibility from that. So you actually would be able to, is our understanding. We did have some people during Alpha that did apply and were granted unemployment benefits as well.
Okay. So another one, what range of probability does your retirement planning give you comfort in retiring?
That's probably a two-part question. I'll go with mine and then let Brian give his take on that. And so if you're looking at, a lot of people we work with at Chevron, you guys are all very technical, and you understand numbers in a lot of ways better than most advisors do. I would say from the input standpoint, you want to look at really two components, and the biggest mistake we see is the rate of return people assume on their investments. I think it's pretty safe to say that if you're looking at a number of inflation plus, call it 3%, you're going to be in safe territory with most calculators. A balanced portfolio is giving you, call it 8% since 1950, but inflation has kind of been up and down during that time. And so the long-term inflation rate's been roughly 2.5, 2.9 in the US. And so that's going to be some good times, some bad times. So really, you want to see kind of 80+% probability when you're looking at Monte Carlo. But the big piece that goes into that really is the inflation plus calculation. We tend to be a little bit more conservative when we're looking at numbers, because while your rate of return, your nominal rate of return on investments may be one thing, it may be during a time when inflation is running a little bit higher, so your real return isn't necessarily as high. And that's a piece that people are missing when they're running a lot of these scenarios. How about you, Brian?
Yeah, I would definitely say first and foremost, inflation is such a critical component to it, because you're talking 20, 30 plus years of retirement. Inflation, it's such a silent killer. You just don't notice it from day to day or even year to year, really. But when you run the numbers out using some of the inflation numbers that we apply to our modeling, it's almost jaw-dropping how much the cost of living will look like in 20 to 30 years. But you look at the cost of living today compared to 20 to 30 years ago, people 20 to 30 years ago would have thought it was crazy. So yeah, we tend to be pretty conservative in our approach regarding that. We want to use, typically a 3% core cost of living number, and certainly with healthcare costs, we use quite a bit higher than that, if double, if not more. And so we also then want to be conservative about what the spending is going to look like. I've had people say, "Oh, well, I'll just stop spending, by 50% or something." It's like, whoa, 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 whoa. Is that realistic? Is that something that we can really think is going to happen? Additionally, we want to think through additional expenditures that will happen as you enter and get into retirement. There might be house projects that you're going to be thinking about. There might be projects that are just out there on the horizon, like replacing a roof. It happens every 20 to 30 years. Buying cars every so often. I mean, we really want to consider all those facets and throw it into the modeling and see how do we look. And so we then apply a linear analysis, which is just simply a straight line year by year. And we typically run about a 4.5% rate of return on investment in that scenario. We then also run it through the prism of Monte Carlo. And so for a lot of the Chevron employees, particularly the engineers, they know Monte Carlo through and through. And what that's saying is, it's talking about a variable rate of return. It's not assuming just a year in, year out growth. And so we then apply Monte Carlo and determine, hey, what's the probability of success? And to your question, one of the questions that was out there from Scott, it looked like, we like a probability of success that's at least 80%, if not higher. That wavers a little bit up or down depending on how rigorous we're running the modeling. We also then like to stress test it, say, hey, what happens if a bear market happens right as you get ready to retire? So for clients who retired last year, needless to say, they're not thrilled about coronavirus right now. So how protected are you from events like that? So that's all the type of analysis we like to do. So hopefully that answers some of your questions there.
All right, I appreciate it. So there's a couple that are getting kind of specific, but I'm seeing a large inflow due to Cobra. So let's touch on that if we can a little bit. There's one example where if my spouse also works for Chevron, is it better to move to her current medical benefits or take Cobra for 12 months, especially if I still have dependents on the medical plan? So I mean, some of these are getting really nuanced. I think that goes back to Brian, how you mentioned we run multiple scenarios when it comes to healthcare benefits and weigh the pros and cons of both. But
yeah, and I can certainly just kind of touch base on a little bit of that right there. So I think some of that would simply come down to here's the good news. If there's a silver lining in this, it's quite likely that you would get to choose whichever scenario was most optimal for you. So if it means that you're the primary, so both you and your spouse work at Chevron and your healthcare is covered through you, and now you separate from service, at least as we understand today, and I will clearly point out, this is a fluid situation. So obviously changes could come from HR saying you can or can't do something. So everything I'm saying right now should be taken with a grain of salt and could change on a day-to-day basis. But to our understanding right now, you could separate from service, go onto the COBRA plan. At the point at which you end the 12 months, that is considered a triggering event. That would then allow you to then jump back onto the spouse's medical that is back in the company plan. So it does allow you to kind of pivot, at least as we understand right now, with the caveat, and a big one at that things could change in the next couple weeks, couple months as this all evolves.
Yeah, and then Brian, also just to stay on the COBRA conversation, are you able, when you move to COBRA, would you keep your current HMO or PPO provider depending on what medical election you chose?
Yes, to our understanding, you would. So, for instance, if you're on the Anthem or the Kaiser, you've got your network, you've got your doctor, that would all stay in the same network. You might, get a different card, insurance card, depending on what that pivot looks like. But you would still be staying inside that same ecosystem. And again, anything related to healthcare, I would, couch it with a caveat of things are fluid and they might change. So we want to stay on top of that.
Perfect. So going through, it looks like we have one more live question. So Brian and Chad, I'll ask both of you this one because I know you've worked with retirees who moved into a consultant capacity. So the question is, when can I become a consultant to Chevron? Does it matter if I consult through an established company versus through a company I intend to establish in my own name?
This is, not sure if this is talking about Bridges or actually coming back as a consultant. I don't think there's any delay with respect to that. What I haven't seen actually, and this took place during Alpha, was there was some terminology with respect to the severance and the timing of some of those things. And so I would actually default to what this round of severance documents that come out because of the Warren Act, how they specifically address this. There's something in my head that there was a 6-month period of time in documents that took place back in Alpha. So I'm going to defer to actually seeing those documents, which I haven't seen one yet.
Okay. Chad, yeah, to echo your point, Chad, my memory around Alpha was it was a 6-month delay before you could come back as a consultant. That's what I seem to recall. But again, we would want to consult the documentation now.
Okay. And then one last one is, if I understand correctly, COBRA will only cover medical and not dental, vision, etc. Correct? I think, Brian, you touched on that, or Chad?
Yes, I believe that actually is correct. Yeah.
And I can actually just go back to that slide. Yeah, so right here, you can note that this will only be applicable to your medical insurance. Currently, I'm just going to wait, guys, a couple more minutes, see if any other questions flow in.
I saw one in here in the Q&A. What tax year is a severance payment taxed at? It's the year that payroll is actually
distributed.
That payroll is distributed. Yeah. So if you get the luck of the draw and for some reason you're on a project and they've got to keep you around through year end and that payroll hits the first payroll of January 2021, you're a lucky one.
A couple other questions. Joe, you're asking about any reason why, corporate tax reason why Chevron would limit the max payout to 52 weeks. I'm not privy to one per se. I don't know, Chad, if you are, but
no, you see some different things with different companies that they've got some calculation, I'm sure, that goes into it from a tax perspective. Maybe they're trying to kitchen sink everything into this year, really and truly, and not drag it out into fiscal year one next year. That's all I can tell.
Okay, it looks like we're getting some more that are coming in a little late. Have you heard of any life insurance policy available for discounted purchase when you sever from Chevron?
The only thing I've heard of is from some of the societies. If you're a member of a trade group or something like that, you maybe get some discounted stuff, maybe through ARP. None of it specific though.
Okay. Another one that just came in. It sounds like choosing the lump sum pension payout will probably be the best for most people. If I'm 45, who will probably get another job elsewhere, what would you suggest?
I can just jump in real quick and just say, to be quite honest, that is a pretty nuanced question, and each person's financial situation would be would dictate an answer one way or another. Those are the kinds of questions that certainly we help our clients kind of solve on a regular basis. We would need to know a significant amount more about your overall financial situation to give you probably a reasonable answer there. I wish I could give you, I wish I could just give you a glossy answer and just tell you do this or that, but it's simply just not that simple, which unfortunately.
Okay, guys, I got one more unless we have others that get typed in. What are some common mistakes you've experienced in past ROMs that we should be aware of?
I would say the sort of blowing up and negating NUA is a big one because, meaning the Chevron ESOP stock, it's so dependent on separation of service. We've had people that had, the dividend from Chevron stock paying out to them while they were employed. They were doing various things while they're employed. That's all well and good. Everything changes after separation of service because it is an employer-sponsored plan. And therefore, that tax benefit is unlocked on one hand, but that also means that tax benefit is at risk on the other. And so, we've seen some pretty hefty unnecessary taxes around that piece.
Awesome. Thanks, Chad. It seems like, I think we gave ourselves plenty of time for Q&A, so it looks like there's a few more keep trickling in. So Brian, I'm going to aim this towards you because you went over the cash flow and tax planning. Question is, Fed taxes will likely go up in 2026. Also, COVID may impact taxation due to shortfalls. You take the change in the 2026 tax code change into account when you do your models?
Yeah, that's a pretty good question. I like where your head is at. Yes, so our tax planning software absolutely reflects the sunset of the personal tax brackets in 2026. We also have the capability of manually adjusting the tax brackets for that point or further out. So one of the questions we've had from clients is, hey, should I be considering Roth conversion? Certainly in the midst of the big market sell-off, we were having that conversation because there are some potential advantages to it. And just as a general strategy where you're in your, let's say, 60s, a Roth conversion strategy before you hit the required distribution at 72 might make a lot of sense. We can actually do the analysis. And so I do have some clients that are very skeptical about where tax rates are going to be as a result of the ever increasing deficit. And consequently, we're running those scenarios and running out the modeling and giving them the specific dollar amounts that might benefit them or not benefit them if they choose to move forward. So again, our job is to really help our clients think through some of these scenarios, make sure that we accurately model it out, and then give them the feedback about what does this look like and does it make sense to maybe move forward. So great question.
Okay. So it looks like a lot of the questions that are coming in now are in relation to the services that you guys kind of outlined and walked through. So before we switch into that, if anyone else has any questions related to the material, please, I'll just pause for a second, just to make sure, we get all the questions answered. If I don't see anything else flow through, we'll kind of go address some of the questions in relation to the services and kind of how you can reach out to our office to schedule a meeting with a financial planner here.
Yeah, I would just say, our process here at Insight, just for what it's worth, we're pretty low key. We are not here to sell somebody something. We're not this is not a sales pressure environment. If someone thinks they may want to sit down with a financial planner, that's exactly what we do. And we would invite anyone who is, considering working with a planner into our office, or currently, obviously, given the current environment, we would do this over probably a Zoom meeting. But we would just get a chance to learn about your situation, what you're looking to do, go through the services we provide, and kind of how that all works. And at the end of that meeting, if we feel like it's a good conversation and we want to keep the conversation going, great. But if it may not be the right time for you, or you want to keep looking, that's completely fine too. We're not here to try to sell somebody anything. We're not going anywhere. We've been around for almost 20 years as a firm now. So, we're not here to try to sell somebody something. As far as the way that we operate, there's really kind of two ways that we get paid. It's either doing a comprehensive financial plan where we charge a flat rate for that work, or if we're managing clients' assets, we charge an asset management fee. In either of those two scenarios, we're not getting paid commissions. We're not trying to sell you some product. We operate as fiduciaries. Certainly as a CFP, I'm a fiduciary held to that standard for that designation. And as an investment advisor, which is the role that we play on the investment side, we're registered investment advisors. There is a fiduciary responsibility there too. So a lot of clients like knowing that it's crystal clear what our compensation structure looks like. And so certainly we'd be happy to go through that in more detail if someone wants to come in and have a seat, sit down with us.
Yeah. So another question came in. Will the slide deck be available? I just want to say yes. This is, again, it's being recorded, and all this information should be on our website tomorrow for your viewing, which will have the slides included. So it looks like one more came in. What is the cost of using your services, and what is the timeline for assessing any financial situation? Brian, I know you kind of spoke on this.
Yeah, I just would say that, obviously I think I hopefully covered the cost. I can't give you a specific quote on a financial plan because I just don't know the scope of the work. It's based on the scope of the amount of work we would need to go into a financial plan. If you think you might want to sit down with us, come on in for a consultation. We'll have a chat. We're not, again, like I said, going to try to sell you something. As far as time scope, needless to say, we got a lot of people who are wanting to sit down with us to help them evaluate this, but we have a lot of staff that support us. And so we are we are ready to be able to help people get the numbers crunched as quickly as possible and get them feedback as quickly as possible about whether or not this makes sense for them. So I would argue again, if you're intrigued by what you hear today, reach out to us and let us know if we can help. We look forward to the opportunity to get a chance to maybe meet you and hopefully work with you.
Yeah, and so I just would like to thank everyone for attending the call. It looks like we're starting to get people to, logging off and just saying thank you for the information. So just want to reiterate, if you guys are interested in having a meeting scheduled, the contact information to reach out to our office is posted on this page, and or feel free to shoot an email to info@insighttowealth.com, and you can just type in that you attended the webinar and would be interested in sitting down with a planner here at Insight. If there's nothing else, I hope you all have a great rest of your day, and that's it. Guys, you got anything else?
Stay safe, everybody. Thanks.
All right, take care.
Thanks, guys.